Omega Healthcare is roughly in the same industry. It's also a real estate investment trust company as Medical Properties Trust. Now, Medical Properties Trust has gone down. OHI, Omega Healthcare Investors, is it a really good buy? Is it a fantastic alternative to MPW? Let's look into that in this video. At the end of the video as well, I'm going to be giving you two really important points to be watching for and monitoring for OHI in the future, so let's get into it. Okay, now from their recent investor presentation, a couple of really key points here, I think. International diversification, it's primarily US based, but with some overseas properties. Large number of beds here, skilled nursing facilities. It's triple B minus investment grade credit rated, but it is close to that line between investment grade and not, and that's going to be important, I think, in this era of raising interest rates. Dividend yield is very high and 9.6, and this is one of the reasons why I suspect and wonder whether or not MPW investors are sort of abandoning that ship and jumping on OHI. Now, from the investor presentation, always take these with a grain of salt. Yes, it is the largest skilled nursing facilities REIT. It has had consistent dividend growth. I'd say that's a little bit optimistic. I think the dividend growth has been rather weak in recent years, as well as they've grappled with the pandemic. But before that, certainly I would say that they had consistent dividend growth. Consistent and moderate dividend growth, and since the pandemic that's been significantly lessened. As I said, good geographic diversification. They also don't have the concentration risk that MPW has, so they don't have sort of large tenants that would put their entire business at risk. They do have some ability there also to acquire other companies and make use of them and leverage that. They do have that investment grade credit rating, as I said, but, and this is a big but, they are one notch above losing that, and it could be quite a tricky balance for them to make in the near term. Now, obviously, with the COVID-19 pandemic, there's been a lot of changes for the company. Now, they list here on this investor presentation some of the impacts, some of what they've done, and some of these outcomes. Now, on a sort of a regular sort of situation, occupancy has increased, but it's only 6% from the low January 2021. So it's not a substantial bounce back quite yet. They're expecting that to improve in the 2023 year. This is probably an important note here as well. Some operators have actually stopped paying rents, and that's about 10% of their contractual rent and mortgage payments. Now, if we have a quick look through Maplewood Senior Living, they've got some proposed restructuring there, and they list some of the financial impacts. Again, proposed restructuring with this tenant, and again, some proposed restructuring with this tenant. Now, some of the things that I do love about OHI, number one here, this triple net lease option feature. So the operators are actually responsible for all those property expenses. Now that's attractive to me as an investor in Omega. Now they do have, as I said, some really nice diversification there across the USA and the United Kingdom. They've also generally got reasonable, they use the term here strong, but I'd say reasonable operator coverage here as well. So the tenants do tend to be reasonably well run. Now, in terms of the overall geographic spread here, as we can see here, the United Kingdom, well, yes, it is there, but it's not the biggest at all, and it's not a huge part of the diversification, but it is an important diversifier, I think. And as we can see from the map, and some of these state colorings as well, they've got reasonable spread there over different parts of the US. Now, are their operators going to stick with them? And one of the big questions there is, when do these leases expire? And we can see probably the first big bump is going to be in 2027, with 15% of the leases expiring in that year. Until that point, I think we should see, barring tenants running into trouble and deferring or pausing on the rent payments, I think we should see some reasonable consistency up until about 2027. Now, as I said before, the operator concentration here, there is some operator concentration, but I think it's not that bad. So the largest one here being about 9%. So obviously if one of these, and in fact, the La Via or Consulate tenant was in Maplewood were listed as some of the operators where they're looking at some proposed restructuring, but it's not that sort of 30% that we sort of see with the Medical Properties Trust and Steward. And so I think the operator concentration or the tenant concentration risk here is substantially less than Medical Properties Trust. Now here as well, as they noted, look, they have been growing their dividend consistently, and as I said, I think that's primarily historic. I would have said, it's less consistent in the last several years. So as you can see here, 2003 through to about 2018, we saw some really strong dividend growth, and since about 2018 it's been relatively static. In fact, I would say this is not consistent dividend growth here. And we can sort of see that it's expected to stay the same here in 2023. And so this 5-year dividend growth rate is somewhat reduced by the levelling off of the dividends here. And so that's an interesting element here as well when you're investing. So at the moment, you're probably investing primarily for the current dividend yield without the expectation of the strong growth that we've seen here in the past. Now switching over to the transcript here from one of the recent calls for the investors, one of the big challenges that they see coming forward is based on the operator discussions to date. They believe the first quarter funds available for distribution will be less than a current dividend. And now that's a little bit concerning. So essentially they're saying, the funds available for distribution will be less than what they pay out to investors. Now, that's concerning. Basically, they're paying out more than they're bringing in and having available for the payout. So what do they sort of see here? Well, they believe that these current restructurings will be resolved soon. And then they'll be returning again to a funds available for distribution rate in excess of the dividend. And they say long term, look, they're still remaining optimistic. They kind of have to say that, don't they, though? But there are reasons here, as they acknowledge, to be cautious in the near term because the operators are still having issues with staffing. Staff costs are high, and getting the appropriate staff is still challenging. And that's not something that can just be, changed instantly because the staff need to be trained. It's not something that can happen in 2 or 3 months either. And so even though this might be an attractive industry to work in because of the relatively well-paid staff, opportunities here and employment opportunities, it still takes somebody wanting to break into the industry, it takes some time to retrain for that industry. Now, one of the reasons that I do enjoy reading the transcript calls is you often get insightful questions that's just sort of asking, that dig into the issues that are on the mind of every investors. Now here, for example, they're saying, hey, look, given the building blocks of operators are coming back online in the second quarter of 2023, does that trajectory of improving cash flow give the board confidence to maintain the current dividend? Now, we'll notice here they're not asking about growing it, they're just saying maintaining it. The worry here is of a dividend cut. So what's this trade-off here? Now, the comment here is they make the decision every quarter based on what's going on, which is, prudent. And what are they saying? They're saying, well, they have a number of operators in quarter one, as we saw, that are not paying, but they're expecting to see a big pickup in operators paying in quarter two. And as some of that restructuring takes place, as HMO, as a major tenant comes back online, they should get back to roughly the contractual rent. And so there's a lot of moving parts here, but that gets us, they say, back into a reasonably comfortable funds available for distribution that they believe is going to cover that dividend this year. Hey, right, now I've turned over to fast graphs, so I just want to get a sense of what might be happening and what the analysts expect to happen in the next several years. So first off, I'm just going to switch over to the analyst scorecard, and we can see here, dealing with the adjusted funds from operation, we can see that in 1 year forward, analysts get it wrong about 1 in 6 times, but most of the times they're about right, and a quarter of the times the company beats analyst expectations. In the 2 year forward, actually, analysts more or less do get it right a lot of the time. 92% of the time they at least get it accurate, or the companies beat expectations about 1 in 6 times. And so that gives me some comfort with the analyst expectations for what is going to happen in the future. Now, a couple of key points here. Number one, yes, dividend yield is relatively high. Number two, the BBB- credit rating is borderline investment grade, and I don't think it's going to take much. As we saw they've got the tenant restructuring, they've got some challenges there in cash flow. Yes, they've got a strong balance sheet, but I don't think it's going to take much to sort of tip them over the edge. Now, as interest rates are high, if that happens, it could cause some challenges for the company moving forward. Now, analyst projections of the AFFO, as we can see here, over the last 6 months, these have been revised by analysts downwards for 2023 and 2024. So what once would have been a reasonable coverage of this dividend here, represented in the white line, we can see here is now looking at a fairly tenuous expected dividend payout ratio here of over 100% for 2023. And 95% for 2024. So what that means is, there could be the potential here for a dividend cut. These analysts might revise the AFFO estimates for 2024, 3 and 4 upwards even further as this restructuring takes place and it's demonstrated to be successful, and the rent collections increase in 2023. This might pop up, hopefully, and avoid a dividend cut here. But is it on the cards? Maybe. Now, would an MPW, a Medical Properties Trust investor, be interested in this? Well, number one, there's a nice dividend yield. The company doesn't have the same sort of recent history of dividend increases that MPW has had, but it avoids that concentration risk of the tenants that MPW does have. But on the other hand, Omega Healthcare also has this elevated dividend payout ratio here, which is going to be somewhat concerning. So I'd say they're skating fairly close to the line. Now, if we assume that they can maintain their dividend payments, and we assume that the AFFO estimates are accurate and the prices return to this normalized price to AFFO ratio of just over 11 times, by the end of 2024 we might be expecting a total annualized rate of return of 14% almost, which is not bad. Most of that is going to be the dividend yield, but I think there are better options here in the market. I would be concerned about the dividend payout ratio. But it's certainly an option that has high yield. They've got a proven track record here. They've got an exceptionally talented management team, I think, and so there are certainly some opportunities here. So hit me up in the comments below. What do you think? I do have investments in OHI. I do like the dividend yield, but I am looking at the future now, and I'm looking at this carefully. What do you think? Hit me up in the comments below. Let me know if this is part of your portfolio, and if it's not, why not? And what would it take for you to be interested in investing in Omega Healthcare investors?